ever, but we did this at the Market Summit where we did the first half outlook. But this is our first impromptu YouTube live stream. So next to me, we have Chris Paris, our Chief Investment Officer, and we have James McFarland, our Senior Portfolio Manager. And tonight we're going to talk casually about the recession. We had a big GDP print today. We may or may not be in recession. We'll get into that. Inflation numbers, of course, that's hot on everyone's mind. And we're going to talk about the stock market, volatility, heading into the midterm elections. But most importantly, what we're going to do is tie this all back into what it means for you and what it means for your retirement. So, Chris, when we look at the GDP print that came out today, so traditionally, if we have two consecutive quarters of contracting GDP, it means we are in a recession. Obviously, we have some pushback from the White House and those on the left and the media. What is your take on, are we in a recession? What does it mean for the markets, and what does it mean for our people listening?
Thanks for asking, Troy. I'm a data guy, engineer, finance. Yes, we're in a recession because the numbers say we had 2 quarters of negative real GDP growth. That's how it's been defined for years since I've been managing money. People can change the definitions all they want. I think when we look back, that's how the data will line up. I'm not an economist, and I've had all those classes. I don't care that much about whether we're in a recession. I care about what it means for your money. You know, how far we're into a recession, and is this just a downturn in the economy that's largely caused by our own doing? Last year, printing way too much money, giving people checks in the first half of 2021, monetary and fiscal stimulus. And that just made the first half of this year look really hard to comp against. And so, you know, what's it going to look like in the fourth quarter of this year and the first half of 2023 is what I care about as the CIO here, and I know what James cares about as the portfolio manager.
And so, Chris, you're not an economist, but you do have the Harvard MBA. So, so you manage money, Chris, in a lot of different environments.
We don't like to publicize that. So.
You've managed money in a lot of different environments. Even back to the .com bubble, you were in small cap management, I believe, was it San Francisco?
I was in San Francisco. Yep.
And when we look back at the recession, obviously we had a quick recession in 2020 when COVID hit. And that was swift and that was brutal, and that obviously was tremendously damaging to your portfolio, to everyone's portfolio out there. But when we look at, historically speaking, you've been very successful throughout your career. You've accomplished a lot as far as managing the #1 mutual fund in the country, which we have on the website here, the #2 over both 3 and 5 year periods. What is different about recessions in the past, whether it was a .com bubble that led to the 2000 to 2002 recession or the 07 to 09 recession versus COVID, the swift recession, and what we just kind of entered into right now?
Okay, thanks, Troy. So 2020 with COVID, I thought as a portfolio manager, chief investment officer, it was easy. It was an event. It was like 9/11. You knew the government was going to throw a ton of stimulus at it. We'd get out of it relatively quickly. In our podcast and our outlook for the first half of 2022, back in November, you know, our team thought that we were going to have a very sloppy, choppy mess of a first half. Did we think we were going to go into a bear market? No. You know, we thought it was going to be a correction. We've gotten into a bear market, you know, down over 20%. We're back above that now. I think down around 15% year to date. You know, this is probably the most difficult year I've seen in 25, 30 years of managing money. You know, I haven't lived through anything like this before. I've studied about it. And the things that you look at historically is, yes, it's happened before.
And specifically, you're talking about inflation.
Inflation, a recession, and the stock market. And we've done some YouTube videos. You can look, I think July 1st, we put out one titled Opportunity Knocks, put another one out on July 8th when the markets were down, because we were looking at data that said, you know, the Fed just raised rates by 75 basis points on June 16th, I think, for the first time. The data was the last time they did that was November of 1974, which just happened to be, we were in a recession and inflation was running 8% plus. And lo and behold, that was the dead low for the market for the next 12 to 18 months. And that's what I care about from an investment manager. I care about what does it mean for the markets.
So the podcast that Chris refers to, you can find on the website every Friday morning. Chris releases one. It's been almost 4 years now. Every Friday we have a Stock Talk podcast that goes out. You can find it on iTunes. You can find it in your local store there on your iPhone or your Android. And what the purpose of the podcast is to help, if you're a client, if you're not a client, to help you understand what's going on in the economy, the markets, and what it means for you. And what we try to do is help you tune out that noise. So if you've not listened to the podcast, I highly recommend you check those out. Chris has done a great job with those, communicating to the listeners what's going on in the markets, the economy, and how it impacts you. So for those just tuning in, every 15 minutes, we're going to do a raffle. We are going to give away a $100 gift card to, I should say, to your favorite restaurant. So it's going to be a gift card for the restaurant. And you have to sign up for that. So we're going to do a random number generator where everyone who signs up for this raffle, it's going to go into an Excel spreadsheet. And if you're row 6 or row 10 or row 40, we're going to do a random number generator to generate a winner for that gift card for the restaurant. So in the description box down below, you can sign up for that raffle if you've not done so already. That is a $100 gift card. We don't know how long this is going to go. This is kind of a casual conversation we're going to get into, tying it to your retirement, your portfolio. But we hope to go for about an hour, give 4 of these gift cards away. I do want to say you have to be present at whenever we call your name as the winner to receive that gift card. So, James, you did a podcast as well. I don't want to kind of sidetrack the conversation as well, but James has an excellent podcast about investor behavior, the psychology of investing. It is really, really, really powerful, and I encourage you while you're perusing through the website to check James's out as well. Okay, James, so we're technically in a recession now. On the portfolio side, on the investment side, what steps can people take, or what steps are we taking from an investment standpoint to either protect the portfolio, defend against what's going on,
right,
or should we even be doing anything at all at this point where the market's already going through this seesaw?
Right. And when it comes to protecting portfolios, the most important step has to already have taken place, and that is how your asset allocation is decided. Asset allocation is responsible for over 90% of investor returns. That's how much you have in stocks, how much you have in bonds, how much you have in real estate, all these different asset classes. If you wait until after you have a huge market decline to think about these things, it's already too late. These questions have to be addressed up front, which is why it's so important that our advisors, when they speak with people, this is the first thing that they sit down and figure out. How much is appropriate? How much works within a financial plan? With that said, let's assume we have a 100% stock investor. So what we've been doing so far is really coming back to the recession discussion. Like, I also agree that we're in a recession. We've now entered a recession. There's going to be some politicking going on this year, but no, we're in a recession. And what's important is we're not heading into a recession. We are already in a recession. And when you're already in a recession, the attitude needs to be that you're looking for opportunities to buy. Looking for opportunities to buy stocks that look good for your particular goals and situations. Not investment advice, by the way. On the opposite side, if we were heading into a recession, it would be the opposite approach. We'd be looking for opportunities to remove risk from equity exposure. But that's not where we are. We don't think. We could be wrong, of course.
And this is the big difference. So we actually had a question. So if you have not, or if you haven't sent a question yet, you can send in a question. We asked for people to pre-submit some questions, and we have some really, really good ones. But if you have a question and you want to submit it, feel free to go ahead and do so. We will do our best to answer it on air tonight. But we had one question that came in. I'm going to butcher your last name, Mike, but Mike, I want to say Naquin, N-A-Q-U-I-N here. So Mike, when you asked what changes on a per client basis is Oak Harvest doing during these downtimes to help clients maintain their portfolio values and still make a decent return. This is a great example of when we're in the midst of a recession and the market's down, we don't want to necessarily, generally speaking, be making massive changes in this type of environment.
That's exactly right. These are the times when your emotions are screaming at you. And when your emotions are screaming at you, it's very hard to think clearly. You're more likely to make a bad call than a right call if your emotions are just making you feel awful. And you're focused on that one instant of wanting to feel better, which you might feel better for that one instant. But then 6 months to a year down the road, you look back and realize you just cost yourself potentially a good amount of your wealth. And in retirement, it really matters.
Yeah, and so we talk about this a lot. So when we look at the investment portfolio has a purpose. In order to have success in retirement, you have to look at your investment portfolio as nothing more than a tool to help provide a comfortable lifestyle, a comfortable retirement. So it's not about outperforming the market necessarily. It's not about catching the next hottest stock. It's not about trying to make double-digit returns on a consistent basis. You need to make, in my opinion, the type of returns with the level of risk that you can sleep at night that helps you to spend the income that you want. Give the money to the kids or grandkids if that's your goals, to charity, to whatever it is that you want to do with your life in retirement. Our belief is that your portfolio should be managed in a way that has the least amount of risk while also being part of a larger plan to target the rate of return you need to spend the level that you want, to bequeath the amount of assets that you want to bequeath and to whom. So it's so much different than the accumulation phase when you have 20, 30 years on your side and we can just invest and we can write all these things out, and you don't necessarily need as much sophisticated planning in the accumulation years as you do in the retired years. But when you're in the midst of a recession, technically speaking or not, when the markets are going down, this is not the time where you want to be making significant changes or trying to time the top or trying to time the bottom. This is where investors, in their study after study, Dalbar puts a great one out, DALBAR, the Dalbar study, where it does a quantitative analysis of investor behavior, and it shows quite clearly over, I think it's the past 20 or 25 years, that the average retail investor, because of the emotional involvement of them being inside their portfolio making changes in times of high volatility, significantly underperforms the overall marketplace. And it's directly related to the emotional component. So on a per client basis, let me kind of answer the question here for you, Mike. Part of the financial planning process is to make sure that we understand what your income needs are. How much income do you need? When do you need that income? Are you retired? Are you soon to retire? And we want to make sure wherever that income's coming from, it's not subject to that level of volatility or market risk. So it's not so much what are we necessarily doing, changing the ingredients, so to speak, inside the recipe. What we want to do is have a solid recipe that when we put it into the oven and it comes out at the end of the day, hopefully it tastes pretty good. And metaphorically speaking, that means your retirement is a bit more secure than if you did not have a plan.
I want to bring in some. I'm the data guy, so I just love data with engineering and stuff. And to James and Troy's point on a recession, by the time the government data says you're in a recession, you go back and look historically, and most of this data is on our prior podcast, but we'll share it with you again in the future. By the time the government says that was the low in our growth, the stock market has already bottomed 4 months earlier and is up on average 21%. And by the time the economy's growing again, just incrementally, the market's up another 10%. I mean, to put that into context, if that were to have happened this year, the market would be at or near all-time highs later this year before the government data came out and said, okay, exhale, everything's okay. And it does you almost no good to wait around for government data. It's revised multiple times. It's almost always wrong. It's late. Managing money, it doesn't help.
We talked about this in the investor, I guess it was called the Market Summit, where we did the first half outlook. Yep. That's on the YouTube channel if you want to go check that out. It was a great time. We had about 60, 70 clients in the room, and it was our first ever actual YouTube live stream. We talked about the stock market being a leading indicator there. And a lot of times we'll get questions, well, Troy, why is the stock market going up when there's all this bad news out there? Or why is the stock market going down when there's good news out there? And today this week has been a perfect example. So the Federal Reserve yesterday, I believe, raises interest rates 75 basis points. The Nasdaq's up 4%. That's counterintuitive to what you would expect to happen. Historically speaking, when interest rates go up, tech technically struggles or traditionally struggles. But tech was up 4% yesterday on the same day that the Federal Reserve raised interest rates 75 bips. Today, we get a negative GDP print, and technically we're in a recession, but at the same time, the markets have a very good day. So when we talk about it being a leading indicator, the market already had a pretty good idea that a lot of this was going to happen. So as we saw the market kind of coming down over the past few months, it's not unreasonable to assume the market had a pretty good idea that this type of movement was going to occur in regards to the economic numbers and also the GDP print. So, okay, so we have our first raffle. It's time to draw our first raffle here. So I have an alarm, and we are going to
Wing it.
So
we're also celebrating New Year's a bit early.
Yes. So it's we're gonna do a random. We're gonna generate a random number. So again, if you signed up for the raffle, you are in an Excel spreadsheet. Your name corresponds to the specific row that you are in. Heather's going to do the random number generator now.
It's
Stu. Stu. Do we have other Stews in there so I can? Stu. Okay, Stu, you are a winner of the raffle. And yay! So our marketing team will be in contact with you. They will reach out. It will be a gift card to your restaurant of choice. And thank you very much for tuning in, Stu. And we really do appreciate it. Okay, so we're going to have another raffle. If you have not signed up, you could be the next winner. You do have to register for the raffle, though. In the description box, there's a place where you can sign up. I believe it's a link where you can click, and you may be our next winner. So make sure you go ahead and sign up there.
And now, as you've seen, if you wait around another 15 minutes, you get to see us react to very loud noises.
We got a lot of questions that came in about your specific situation. So I'm not going to be able to provide investment advice or financial planning advice specifically to you in this type of format. But if you want to sit down and you want to have a conversation about your retirement, what all of this means for you, are you positioned? Do you know where your income is coming from? Do you know how you're going to pay less tax in retirement? Do you have a success plan in place? Do you have the investment and risk management component, the income plan, the tax plan, the healthcare plan? Big news on healthcare planning, actually, I'm going to get into tonight with a piece of legislation that was passed today. Big news there. And then also the estate plan. So if you don't have those pieces in place, I do encourage you either reach out to us through the description box or give us a call at 1-800-822-6434. We have someone standing by actually to take your call and get that scheduled if you want to have a conversation with someone, see if you're a good fit for working with us, and also we're trying to see if you're a good fit or we're a good fit for you. So, good transition here or segue into from the GDP print to the legislation that was passed today. So I believe this is called the Print More Money and Raise Taxes to Reduce Inflation Act. So
it's a much better title than what it's actually called.
Yes. So, but it is a slimmed down version of the Build Back Better. And this was, I believe, originally a $3 trillion piece of $3 trillion.
Pocket change.
Originally, it was a $3 trillion piece of legislation that Joe Manchin from West Virginia blocked for the past, let's call it 12 to 18 months, really. Today, a very slimmed down version passed called the Reduce. I almost can't say that with a straight face.
Yeah.
Called the Reduced Inflation Act. And ultimately, it's a much smaller amount of money going into the economy. So, James, talk to us a little bit about that.
Chris is going to be your man for this.
Man, it's government spending your money, right? Or trying to spend your money and justifying. If you look at the detail, they say it's a deficit reduction, which we all know is not going to be the case because the way they do the accounting for the government is borders on insane.
Do you have any idea, real quick, as far as pieces of legislation that the CBO has scored, let's say over the past 10 years or 20 years, has a single one of them actually been accurate?
Never. I mean, I've looked historically. I think Social Security was off by a factor of like 10 to 100 magnitude over the first 20 years. Medicare Part B, I think, was George Bush's, kind of love child. That was off by a factor of 2 to 5. I mean, it's just atrocious. But the parts within it that people are talking about, there's the clean energy part, which is more subsidies for people going out and buying new electric cars, which are exorbitantly expensive right now because you can't get parts. There's another part on it that is on the medical side and is supposed to reduce drug costs in the future. I think it's going to cap people's out-of-pocket expenditures on the Medicare side, maybe $2,000 a year, which sounds great, but the way it's structured, it's going to inevitably force more prescriptions into those drugs for the first 3 to 5 years, and probably raise prescription drug costs across the board before they get to negotiate on the other side cost reductions 5 years from now. So it's a mess. Luckily, it's a much smaller mess than they originally asked for.
And so the one thing that is, from a planning perspective, and look, when it comes to these monstrous pieces of legislation on the left, on the right, whatever it may be, what we have to do from a retirement planning standpoint is understand how can we apply what the new law is to your particular situation to put you into a better, to help you save money, help you reduce taxes, help you pay less in health insurance costs. In this particular example, from the American Rescue Act, for the past 2 years, you could have a much larger adjusted gross income and still qualify for a subsidy to help pay for your health insurance if you retired prior to Medicare age 65. So what this legislation seems like it's going to do, and it's not passed yet, but and I did say it has passed, but it passed. The Manchin is on board, and it seems like it is going to pass, but it's not a done deal yet. What it's going to do is allow you to still receive a subsidy, it seems like through 2025, of your health insurance premiums if you register on the exchange, even if you make up to and even above $100,000 per year. So if you want to retire at 62, one of the biggest reasons that people continue to work is health insurance costs. If you're married, age 62, it's not unreasonable to have somewhere around $2,000 a month in health insurance costs. And that's just for health insurance. That doesn't include your copays, deductibles, all the out-of-pocket expenses, prescriptions, et cetera, that come with that. So when you look at the ability to have an income of $60,000, $70,000, $80,000, $90,000 and still receive a subsidy from the government to cut your health insurance premiums possibly from $2,000 a month to maybe $1,000 a month or $1,200 or $800. There's an entire calculation that we do. Part of the income planning process is identifying not just what makes the most sense in this year as far as where you withdraw your funds from. Many of you have it in the IRA, you have it in the 401k, you have some savings and non-qualified accounts. An income strategy is how much am I taking from each one of those places in order to, to manage the 1040, your tax return. So when we look at that, not just in the current year, but we extrapolate out into the future and we start to weigh the pros, cons, cost, benefit of various decisions, what this allows us to do is for many of you, help you to get retired sooner than age 65 because we can kind of manage that tax situation with this new piece of legislation. So that was a lot to digest there, but most importantly, it all comes back to what does this mean for you? And from the planning standpoint, from a retirement planning standpoint, the big takeaway, if you've watched the show for a long time, if you've been a YouTube subscriber, or maybe this is the first time you're coming across our firm, what this means for you is it's not just an investment strategy. We had a couple questions on here, how should I be investing? That is oftentimes one of the least important decisions that you'll make in retirement is how the portfolio is actually constructed. The bigger parts, a lot of the times, is the income strategy, the tax strategy, the healthcare strategy, and then the estate plan. So you can do everything right on the investment side, but if you mess up the income, the taxes, the healthcare, and the estate, all that was for naught. So if you don't have that in place, feel free to go to the description box, reach out to us. You can schedule a conversation with one of our advisors, and we have someone standing by. So the phone number, if you want to reach out to us now to have a conversation, see if we're a good fit, if we can possibly help you out, that number is 1-800-822-6434.
So that, and speaking from my background is also purely in securities, purely in investment management and institutional money. And it really surprised me when I joined Ocarvis now almost 6 years ago, how small a piece of the overall retirement puzzle investments can be in certain cases. And I wonder when you sit down with a new client or a new prospect or a new person that you're going to help, do you find the same kind of thing with those people? Are they surprised by that?
Yeah, absolutely. You know, to put it into better context, when we're hiring new advisors, so sometimes, and we don't do this anymore because it's too much too much trouble. But we used to think that it was a good idea to get the 30-year veteran from J.P. Morgan or Morgan Stanley to come in and help work with our clients. The problem was, and look, these are great firms, but what we do here from a planning side is it's just so different from what most investment advisors have done throughout their entire career. It's just is difficult to train someone, typically, generally speaking here, that's been doing investment advice for 30 years as it is someone coming out of college that we can kind of bring up and train them. And so, yes, it is for clients, but a lot of times I call it the light bulb moment where usually you don't think about it until you maybe a year, 6 months away from retirement, sometimes until you actually retire, where, oh my goodness, I have all of this money. How do I take it out of my accounts? What about taxes? What about healthcare? What about insurance? What about all of these wills, trusts? That's the light bulb moment, and that's typically when people start searching on YouTube and they find our videos and they give us a call. But the wide majority of people still believe that just investment planning is all that's needed in retirement. And that's an accumulation. That's an accumulation phase mindset, not a retirement phase mindset.
Right.
So I wanted to touch a little bit on that, but I do also want to go back to the Federal Reserve raising interest rates 75 basis points, and the NASDAQ soared 4% yesterday. We kind of touched on this, but I want to give you an opportunity to speak a bit more to the topic. Why did the market go up so significantly on a day when the Federal Reserve raised interest rates so much, and what do we expect over the next few months?
Well, this is going to be a shameless plug for my next two YouTube videos, one that comes out tomorrow and one a week from now, because I'm writing on just this subject. In a week from now, the title is going to be, Did I Miss the Low? And so what's happened year to date, actually it started last November. Interest rates started moving up last November when the Federal Reserve finally got off the can and said, we've been too easy in the markets, we printed too much money, we're going to start to tighten monetary supply. And they alluded to that in November of last year, and ever since then, interest rates have kind of started to rise. And if you go to the podcast, I talk about there's nominal interest rates, which everyone on TV talks about. The 10-year Treasury is 3%. And there's two components of interest rates. There's inflation and there's real growth. And you add those together and you're nominal. And ever since November of last year, the real interest rate has gone up. And it was dramatically negative for years, like 2, 3, 5 years. And it went from negative 1.5%, and I think in June timeframe, it might have hit 75 basis points. And it went up almost in a straight line the first 6 months of the year. And on June 16th, when the Federal Reserve came out and said, we're raising rates by 75 basis points, real interest rates peaked, and the stock market so far has made its low at 36.25, something like that. And ever since then, the leading stocks have been more or less the high growth stocks that were just getting crushed. The Federal Reserve's raising rates because they're trying to tame inflation. They see that all the policies they did last year, they were overly aggressive, are hurting particularly lower income, because inflation is a regressive tax. I mean, it hurts the poorest people the most because more money is going to fill up your gas tank or food. Those things you just can't get rid of. So they're trying to slow down inflation. Inflation
represents a larger portion of someone's budget on the lower side of the income scale as opposed to someone on the higher side. Yep. So one of the questions, I want to make sure I get the first name here at least. James, here it is, from Ginny. Ginny said, how does raising the Fed fund rate help in reducing inflation? Really, really good question. Guys, what do you want to take this?
Right. Well, essentially they're trying to control demand, push demand down, which will reduce spending. And so if more people want something, then the price of whatever it is they want tends to go up, right? If more people want the same thing, price goes higher because there's more competition for that thing. The Fed is trying to push the demand side of the equation down so that prices come down, and when prices go down, that usually equals inflation going down at the same time.
Yeah, ultimately, they're raising the cost of money, so
yes.
It slows the economy down. So
just tapping the brakes, or trying to tap the brakes without crashing the car.
And that's a good analogy when you hear people in the news talking about a soft landing versus a hard landing. So a soft landing would be tap, 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 tap the brakes. A hard landing would be the deer's in front. I guess you should hit the gas at that point, but slamming on the brakes, that would be a hard landing for the economy.
The easiest place to see what they're trying to accomplish is in the mortgage market, right? So the Federal Reserve has raised interest rates this year. I think Fed funds rate is 2.25%, 2.5%, but mortgage rates have gone from, they were 2.5%, 3% last year. I think they hit 6% earlier this year. That zaps mortgage demand, the ability for a lot of people to go out and buy houses.
Right.
And what you've seen is a dramatic fall off in the demand for housing. People are no longer bidding 5%, 10% over the listing price for a house. People aren't showing up to buy houses, and demand is falling off pretty quick there.
Yeah. So excellent question, Jenny. Very, very good question. Ultimately, it's slowing down the economy. So we are at that time where we are going to do another raffle. So if you haven't signed up for the raffle, what we're doing is we're giving away a gift card every 15 minutes to your favorite restaurant. You have to go to the description box. There's a link there. You can sign up, and once you sign up, you can qualify for the next raffle that we're going to be giving away, which we hope to do at least 2 more of these. While do we have it up, Heather? Well, Heather.
Yes. Jay Evans.
Jay Evans. So Jay Evans, you are the winner of the second $100 raffle. Our marketing team will be in contact with you to arrange that. So thank you very much, Jay, for tuning in, and we really do appreciate it. And if you're watching and you have questions and I don't get the opportunity to answer your question here, we do have someone standing by. They're not going to specifically answer your question. He's not an advisor, but Zach will take your information, get an appointment scheduled so we can have a conversation about you, your retirement, what we're talking about here. If you don't have an income plan, a tax plan, we had a client recently where we're going through the tax numbers, and if he would have kept doing things the way that he was doing it versus what he could possibly be doing, the potential savings was tremendous. It was in the hundreds of thousands of dollars. Now, this is potential, and of course, we need to run the numbers for your particular situation, but generally speaking, there is a lot of money that could be on the table from a tax planning standpoint for having a tax plan versus not. Healthcare plan and estate plan too. It's all part of that comprehensive process here. So if you want to have that conversation, you can give us a call at 1-800-822-6434. Reach out to us on the website. It's oakharvestfinancialgroup.com. There is a link in the description box. Again, that phone number is 1-800-822-6434. Okay, guys, so I have a note here as well. There is a QR code that's coming on the screen. If you want to scan that QR code, you can register for the raffle right there as well. So we have 2 more of these raffles coming up. The raffles will provide $100 gift cards, each one, to your favorite restaurant. Okay, so we have some, this has been an incredible week as far as the news. So we've had the GDP print. We had the Fed raise interest rates. We had, seems like a pretty good-sized piece of legislation that's going to pass, which is pretty big news. And on top of all that, more than half of the S&P 500 has reported earnings. So what do those earnings look like, James? Are they coming in good? Are they coming in bad? What is, in regards to the earnings, how much is that contributing to the rally that we're seeing in the market this week?
Yes, earnings. This is it's earnings season, and this is earnings week, where literally half the S&P is reporting in this 5-day period. And most of the companies you would know, Amazon, Apple, Microsoft, Google, the largest of the large, the most important of the most important in the S&P. And generally, earnings are positive, which, if you just look at the news, you might be surprised to hear that. And the media is just nonstop negative, 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 negative. But earnings. So far, we have 71% of S&P, the components of the S&P have reported so far, which is about half, have beaten earnings estimates. And some people might say, well, estimates are so low now. Well, that's not quite true. Estimates tend to start the year high and then they gradually lower over the course of the year. So at this point, they're not all that low just yet. We also have the very, very strong US dollar right now, which should be impacting these companies. A lot of our biggest multinational entities have a lot of international business. It's in the name. But in spite of that, these companies are performing well. They're producing earnings that show strength, which is a positive, I would say. And definitely, certainly contributing today to the companies that reported today, their after-hours movements in those stocks has been quite
Yeah,
significant.
what do we see? Amazon, was it Amazon?
Amazon
was over 10%?
over 10% after hours.
After hours markets are a little less liquid, so that may not hold when the market's open tomorrow morning. But the currency thing it's complicated for a lot of people.
Sure.
When you do business overseas and you have to convert the dollars, or I guess let's say euros, back into dollars from the goods you sell overseas. If you get euros, you then have to convert them back to dollars. If the dollar appreciates in value relative to the euro, you're going to get less dollars, so your earnings could be negatively impacted because of the strong dollar.
Right.
So hopefully
right.
the hand signals kind of helped you out there. But the point there, the big takeaway, and what this means again for you, because my job here is to really kind of tie it all back into your money, your retirement. This is what it matters and what you should take away from this, is despite the Fed raising interest rates for the first 6 months, despite the negative economic numbers as far as the contracting economy, we still have very strong earnings coming from these companies, despite the fact that we do also have a strong dollar, which is eating away into
That's right.
those profits.
That's exactly right.
So what does this mean for you? So many, and look, we don't talk too much, we try not to get into politics too much here. But we do see oftentimes people making investment decisions based on their politics. And that is one of the worst things that you can do. I can't tell you how many clients, prospects that we talked with during President Obama's 8 years in office. And they would say, Troy, there's no way we're going to invest any money. Well, the markets averaged somewhere around 15% per year while President Obama was in office. And then the same thing when President Trump came into office. We had so many people say, Troy, I'm never going to invest. The country's going to this and that. And the truth of the matter is the markets did really, really, really well. Now we have what looks like a challenging economic landscape. We have technically a recession starting, I guess, today. Technically. And I'm sure a lot of people watching this are thinking about pulling all of their money out of the market and going to cash. And maybe you went to cash a month ago, or you're thinking about going to cash. We can't give specific investment advice, but we can talk, generally speaking here, about what history tells us during times like this, what going to cash ultimately means 2 years from now, 3 years from now, how bad of a mistake historically that is. And I bet you have some data.
I got some data. So it is a midterm election year, as Troy said. We can look at election cycles, presidential cycles, Democrats president, Congress is divided, whatever makeup. Historically, the second half of a midterm presidential cycle, specifically the fourth quarter through the next year, which essentially be the fourth quarter of this year through 2023, is the best time period to be invested in the market for any president. It doesn't matter if it's Democrat, Republican. I've got all the data. We can post it. It really doesn't become that relevant.
Well, we have. We've talked about it.
Yeah, we've
talked about it for months. You can go back to November of last year, where we talked about the choppy first half and what we anticipated to take place in the stock market. And then the second half, things most likely were going to start to look up.
Correct.
So all the way back to November, they could go and find that.
Yeah, and whether we like it or not, whether we're liberal or whether we're conservative, the stock market likes the certainty of nothing getting done in Washington, D.C., right? It would love a Democratic president and a divided Congress and nothing ever getting done. And that's more or less what it looks like we're going to probably get if you believe the polls, which have been very accurate in midterm election years, that the party that won the year before tends to lose a lot of seats in both the House and the Senate. So, and with that means that you take Washington, D.C. and all the budgetary bickering out of the equation for the next year, and it comes back to what's the economy doing? Are we back to a slow, boring, gradual growth environment, which is Goldilocks, right? It's the internet bubble. I lived it, right? I was in San Francisco in 1997. I left in 99. It was a blast on the way up, and I'm glad I left before it crashed, right? Trading stocks last year in the first half, when the Fed was just pouring money in and stocks were going up in integers, 2, 5, 7, 10 a day, I mean, that feels great, but as a retiree or as a saver and investor, it doesn't do anything for you. It might make you feel good, but I've only met 1 or 2 people in my life who've made enough money in a 1 to 2 year time frame trading stocks like that, and they sold everything and quit. Everyone else I know, traded and then lost everything that they had traded positively. So we want to get back to boring later this year and in 2023.
I just love that you worked integer into that response. That was very good. James, can you work integer into?
It would be a challenge for me to do that, I must admit. I think working the word integer into a casual conversation is an extremely rare skill.
Okay, so we got a good question here from Fred. Fred, how you doing, Fred? Tips. So the question is that Troy says bonds can be problematic in today's environment. What he is referring to as when interest rates rise, then bond values typically go down. So that creates a problem in an environment where interest rates are rising, and which is played out very clearly this year. Not going to get into the specific numbers because you have government bonds, you have corporate bonds, you have junk bonds, you have short duration, you have long duration bonds. This microphone's in my way. So different types of bonds, but all of these bonds typically will be impacted by increasing interest rates. So Fred says, what about tips? So, and this is funny, Chris, I'm going to come to you for this, and James, I'll give you an opportunity. I asked you, I think it was about 7 or 8 months ago, had a client call me and say, Troy, why aren't we investing in tips? And your response to me was, well, that was 6 months ago. If you're going to buy tips, that's when the time was, not now. And since then, tips are down about 10%. I looked this evening preparing for the show, and I looked at if you type in, I think it's just TIPS into the ticker, it's an iShares fund, which is TIPS Treasury Inflation Protected Securities, down 10% over the past year.
They're down as much as any other Treasury bond for the most part, because they have duration, right? They're not a 1 year Treasury. They have 10-year duration. So
what is duration when you say
duration is maturity. So you can have a 1 year bond or a 5 year bond or a 10-year bond or a 20-year bond, and when you buy that bond, you're locking yourself in, for the most part, to I'm okay owning this and getting my money back, which is all that's ever going to happen 20 years from now, and I'm willing to sit there in my seat. I mean, there's a secondary market for them, but it's illiquid just like anything else. But I'm willing to sit there, and so as interest rates go up, your tip, even though inflation's going up, it's going down in value because there's duration in that bond.
And there's an interest rate component there, obviously. So it's kind of speeding up the maturity in a way, because when we look at the interest payments, if it's a 10-year bond, duration might be 7 or 8 years because we're receiving interest payments there. But the thing that you hit on, which I think is very, very important, because when we look at fixed annuities as an option, as we look at guaranteed lifetime income planning, if we looked at the indexed accounts that could provide 100% safety of principal, these are insurance guarantees. And the opportunity we've seen double-digit returns in any given year, but most importantly, never lose any principal if the market goes down. The big downside to those is a lack of liquidity. Typically, there's 10% annual liquidity and a surrender charge. And these surrender charges for these products can be pretty big. In the first few years, it can be 9%, 8%, 7% if you take out more than your 10% free annual withdrawal. They're not short-term investments. They're designed for the long term. And they also pay commissions as well. But what we often hear with annuities is that I don't want to lock my money up for 10 years. And when you look at bonds in an increasing interest rate environment, not only are you quite possibly locking your money up for 10 years, because as interest rates rise, the value could significantly drop, but you don't know exactly what that downside penalty is. We've seen some bonds this year as down as much as 20-25%, and these are bonds. And interest rates have only gone up, relatively speaking, a small amount compared to what they could possibly go up to.
Yeah, I as one of the investment people here at Oak Harvest, I've actually done a segment on annuities, and I, like most investment people, was skeptical initially, but before I came to work for Oak Harvest, I talked to Troy, talked to the team, and saw how they actually use the annuity as a bond replacement over long periods of time. And all you're doing in that annuity is you're you're entering into a contract to get into the insurance company's assets.
Balance sheet.
Into their balance sheet. So, whether it's, name a company who sells annuities, because I'm...
Allianz is a big
okay,
one.
Allianz is huge. When you enter into an annuity contract with Allianz, you are entering into their balance sheet, and they own real estate. They own apartment buildings. They own bonds that extend, 10, 20, 30 years. And you are entering into that company's balance sheet. And if you want out of that balance sheet, they can't go out and sell an apartment building just because you want out. I know of no retail investor who buys a bond ladder being, different maturities, 2 years, 5 years, 10 years, who trades them, who after 7 years goes, I'm going to sell them all because yields are up or down. I don't know that. So the comparison, the liquidity of an annuity, I don't understand it from an investment perspective. It's not there if the comparison is a bond ladder.
Yeah, I mean, it comes back to the general concept. Whatever financial tool you're using, there are downsides. If you put your money in stocks, the stock market could go down. If you put your money into bonds, the company could go bankrupt, or the bond market could go down in value. With annuities, there you have principal protection on the fixed annuity side, but you have surrender charges and you have limited liquidity. The financial planning component, what we do as financial planning professionals is combine those various tools into a plan that's customized to how much income you need, when you need that income, how do taxes play a role in that overall plan, and then also the healthcare and the estate side. So the tools don't matter. We don't care which tools our clients use. But in this environment, when you have tremendous volatility in the market, you have rising interest rates and falling bond values, we need more tools to help accomplish the goals that you have for generating income. And most importantly, you don't want to give up your standard of living, your comfort of living, your quality of life. And that's what a true retirement plan does. And that's why when we talk about the stock market and earnings, these things are all great and they're good things to know, but more importantly, what you should understand is how does it apply to you? How does it apply to your retirement? How does it apply to your security? So we are at that time again. So we have...
we got to get a lower.
Can we bring the decibel level down a tad bit on those? I don't think I'm going to get used to that anytime soon. Okay, so... so one more time, Heather. James Watkins, you are our third raffle winner. So you will be hearing from our marketing department. They will reach out to you, and that is a $100 gift card for your favorite restaurant. So for those of you just tuning in, we are giving away $100 gift cards to your favorite restaurant. We're doing a randomly generated number. You have to register, though. In the description box, there's a link. You can click on it. Periodically, there's a QR code popping up on your screen, or at least there should be, and you can register there for the raffle also. So we're going to do one more of those minimally. We might do two more, but probably just one more. We'll see. Okay, so I want to take this kind of last segment here to start to go through some questions, and then I'm going to tie it into the financial planning side. I'm going to let these gentlemen talk about the investments or the economic side of it possibly. But before I do that, anything that you would like to add on top of what Chris was just referring to in regards to the bond market and the Federal Reserve raising interest rates? Anything at all?
That's exactly right in regards to bonds. And it's just going back to the point about the place of insurance products within a financial plan or a retirement plan. A lot of times, to me, it was surprising. So I lived in Japan for a very, very long time and then moved back to the United States to join Oak Harvest. And something I noticed when I moved back over here is that a lot of times clients would come in and say, I hate X. I hate this product. I hate this. And that was kind of surprising because to me, if we're dealing with something as complex and individually unique as retirement for your particular situation, your family's situation, why limit the potential tools that you have available that you can use within retirement? Whether it's a type of bond or a stock or a mutual fund, an ETF, an annuity, or something else. Why place those shackles around yourself? use what works for your plan. It's just why working with
Yeah.
a planner is so important.
Yeah. I mean, we have clients that are 100% equity, and they have been for many, many, many years. And we have other clients that want to put a dollar in stocks. I'll share a quick story with you real quick. About 7-8 years ago, had a good client. She was listening to the radio show. So I host a radio show called the Retirement Income Show. It comes on Sundays at noon on 7:40 a.m. here in Houston for 11, 12 years now. So she said, Troy, I heard you on the radio talking about investment accounts and portfolios. And she was all CDs, guaranteed rate annuities, cash in the bank, 100% safe. She said, Troy, I heard you talking about these dividend stocks. She came in on one of her reviews, and I said, yes, but we're not going to do that for you, because I knew her. I knew she couldn't stand she didn't have the willingness to withstand the risk, the volatility of the market going up and down. So she said, Troy, you either do it for me, or I'm going to go down the road and have them do it for me. So I said, yes, ma'am, we'll open that account for you, but I would like to start small. So we start small. She puts $25,000 into the account, and she was worth a whole lot more than that, but she just wanted to do it. So anyways, the very first day we get the account open, and we gradually get money invested here. We don't just get it all invested immediately. So we get, I don't know, I'd say 10, 15% of the account invested. The market's down that day. Sure enough, I get a call at the closing bell. Troy, close the account down. And we're talking a couple $100s here. So if you the point is we have clients that are 100% equity. We have clients that would never put money into the stock market. Whatever tools we use, the most important thing is that those tools are working together in a plan that helps to provide the income that you need, takes a look at taxes, takes a look at healthcare, takes a look at the estate plan. And then when all of those pieces are working together succinctly with one another in concert, then you actually have I can't say you have synergy here, but it creates, from my experience, a synergistic type effect, because it's not just, well, the market's doing poorly, oh no, what do I do? It's, hey, I can take advantage of the market being down with my tax plan. So there are opportunities that are created when you have these various pieces working together. So, but good story, and it's a great point. Okay, so one question, first one up here we have from Philip. How is the account protected with your firm? So I wanted to answer this question because it's a very important question. So we hear Ponzi schemes. We hear this stuff all the time on the news. The number one thing that I believe is in common with these Ponzi schemes is that when you hire someone, you put your money into their particular account, their personal account. Possibly it's an investment they have 100% complete control of, but it's not with what we call a third-party custodian. So here at Oak Harvest, we use TD Ameritrade. They're the firewall between your financial advisor, between Chris and James, the investment team, and you. So TD Ameritrade, which was recently purchased by Schwab. So they're that firewall, and they are the ones that, whether you work with us or you work with someone else, one of the best ways that you can avoid Ponzi schemes is by making sure the advisor that you're working with has a third-party custodian. So if that person is very, malevolent, let's say, they could still find ways to kind of trick the system, but it's one of the best ways to protect yourself is to make sure that your money is not in the personal account of someone, it is in a third-party custodian. So I wanted to address that. When we look at some of the personal questions here, this is near and dear to my heart because we have a lot of clients that have children with special needs or grandchildren with special needs. So someone wrote in here, I have X amount total, this amount in IRA, this much in an annuity, this much in cash. I have a disabled son, he's 45, I need $1 million for him whenever I pass away, and I need $4,000 a month for my living expenses. But then the question is, how should I invest? That's not the right question. The right question is, how can I have a plan that helps me to invest, generate income, have an estate plan, a special needs trust? How can I have these different pieces put together so that my goals are achieved? So it's not about, again, how you invest the money. It's about how can we have a plan in place that helps to accomplish those specific objectives that you have. And it is oftentimes the investment side of it is the least important of all of those ingredients that would need to go into that plan.
I jokingly tell people that, like, James and I are kind of the black sheep at Oak Harvest because we're on the investment team, And everyone else who's doing financial planning, they're the people out there, they're the people creating the plans, holding hands, and making the outcomes that people need in retirement. And I didn't understand it till I came to work here with Troy and Jessica and the rest of the team 4 years ago, that your life, when you're working and saving and accumulating, your financial life is pretty easy. It's not particularly complex. You work, you get your paycheck, you spend it on your house, whatever. Hopefully you pay yourself first and save. Most people don't. Whatever's left over, they save. And you just keep doing that. Once you retire, and you don't have income coming in unless it's Social Security, and even then, most people don't even know when to take it. Your life becomes really complex as far as when do I take money, how do I take it, what are my taxes, are there limits on, do I run into Medicare limits or taxes? I mean, I'm the investment guy. I don't even think about these things.
You're doing great. You're doing really good.
It just becomes, there's 5 to 10 different things versus how's the S&P 500 doing today? Did Amazon beat their numbers? And as the investment team, we're thinking of what are the best investments for the next 6 months to 2 years. Who's going to have the best returns going forward? That's a small portion of being retired or being near retirement.
So we have a question about the Secure Act, and this is very important because our job doesn't stop when a client passes away. So one of our biggest responsibilities is to sit with the children and plan with the children whenever that time does come. It's one of our greatest responsibilities, and it's also one of the most difficult times that we have. So someone wrote in saying, with the Secure Act having passed, what is the strategy or what has changed with your strategy when it comes to naming beneficiaries? So it's an important topic to bring up because strategies necessarily haven't changed as far as you're concerned, the person who is naming a beneficiary. But where the strategy could potentially significantly change is for your beneficiaries. Good example here. So we had a family recently, 3 daughters. A gentleman had passed away, a client for many years. All 3 of those daughters are in different tax brackets. One's married, 2 are married, 1 is not. They all have different circumstances, and the Secure Act requires that retirement account is distributed within a 10-year period. So what we did is we had a planning session with each of those daughters to identify what made the most sense for their particular situation. Our goal oftentimes for clients who reach out to us, it's about optimizing. It's how do we keep more money, how do we reduce taxes, how do we generate more income, how do we take less risk while still accomplishing the retirement goals, which is maintaining your standard of living for many of you. But when it comes time to pass that money on, this is why the estate plan, this is a step 5 in our process, the estate planning, whether you have a special needs son or daughter or grandchild, or in this particular case, we're trying to plan around the Secure Act, the legislative changes that have forced money out of that tax-infested retirement account to those children within a specified amount of time. If you're not careful, then a large portion of that IRA could go to taxes if they're in, let's say, the 30% tax bracket, and now all of a sudden they get $200,000 on top of that. Well, you're looking at 40%, let's call it, off the top of your IRA gone. So the Secure Act didn't necessarily change the beneficiary strategy as far as you're concerned, unless you have what's called an eligible designated beneficiary. There's a few protected classes that do not have to stretch it out, or pay it out within 10 years. So I won't get into those, but the planning side for the children has potentially changed a lot. Okay, so have any questions? Do we have any questions, Megan, that have come in from the, here we go. Okay. As a recent retiree, how often should I be rebalancing my portfolio? And I love it. I'm just going to say from Loveland, Ohio. James, how about I let you tackle this one?
Okay. This is a great question. Rebalancing is a very, very important topic when it comes to managing a portfolio of investments. And the answer to how often to rebalance, it really depends on the type of portfolio you've constructed. Some portfolios are what's called passive, where you're essentially investing in the whole stock market, the whole S&P 500, the whole NASDAQ, what have you. Generally speaking, and again, this isn't something that you can just take and go do. It doesn't work that way. But generally speaking, if you have a passive portfolio, anywhere from 4 times to at least twice a year rebalancing is fairly decent in my view. Other people say once a year. I think at least twice a year, maybe once a quarter, is probably the way to rebalance a passive portfolio. Other portfolios are more active, what we call active investing. That's where you have managers who are actively going out and choosing investments, when to buy, when to sell, how much to buy, how much to sell at different times. Rebalancing becomes more complex in that situation, which is what we do here. And it's more of a flexible, active rebalancing approach, where we're making decisions on when to rebalance, which is to sell some of one asset or one security and buy something else when we think it's an opportune time to do so, when we think it's going to be beneficial in either reducing risk or increasing the potential of a gain in another position, or a number of other considerations that go on. So when to rebalance, it depends on the portfolio you have.
And to kind of add a layer of complexity onto that, oftentimes you have tax considerations if it's inside of a retirement account or what we call a non-qualified account, which is outside of a retirement account. What tax bracket you're in. You may be retired, but if you're 65, you have something associated with Medicare called IRMA. It's an acronym. It stands for Income Related Monthly Adjustment Amount, and it's a surtax. So if you rebalance and create capital gains in a non-retirement account, it could bump you up not only to possibly higher capital gains and dividend tax brackets, it could increase your Medicare premium substantially, 30, 40, 50, possibly over 100 or 200% from a month. So again, it's a layer of complexity, and this is why, going back to your point, Chris, when you're 20 and or 30 years old and just investing, life is complicated, but investing and planning really isn't too complicated. You should just save as much as possible. Once you get to retirement, though, and you've accumulated this money, and now you have to figure out how much to take out, which account to take it from, how does that impact my taxes, how does that impact my Social Security, how does that impact my Medicare, what about these excise taxes like IRMA, net investment income tax, what about trusts, what about all the different aspects that someone needs to be not only educated about, but really experienced when it comes to these various moving parts. So thank you for the question, and I hate to really add that extra layer of complexity there, but the truth is, it is in retirement, it's a very difficult, general question to answer. Yeah, go ahead, Chris.
I was going to say that it depends. If you're 62 and a half and you have longevity on your side and you're supposed to live till you're 105, if you're allocated 100% to stocks, you probably should stay 100% in stocks if you're going to live 50 years or 40 more years. So it truly is individual. And if you've worked with a financial planner, talk to them about this question. If you haven't, give us a call. We'll try to help you out.
When you need income, how much income do you need? All of that ties into that question. So hopefully we've at least, I know we didn't probably exactly answer your question there, but hopefully we've at least given you something to really contemplate when it comes to the various decisions that you have to make around rebalancing.
No. That's a good shot right there.
So it is that time again. We have our fourth drawing for the raffle. And so for those of you just tuning in, this is our fourth raffle. So those of you that have registered for the raffle, there is an Excel spreadsheet that your name has went into and your corresponding row. We are randomly generating a number, and that number is Paul Barbette. Paul, you are the final winner in our $100 giveaway raffle. So,
Congrats, Paul.
Our marketing team will be in contact with you to get that arranged. So, Paul, thank you very much for tuning in, and we really, really do appreciate it. Okay, guys, kind of final notes here. I do have some more questions, and I apologize. We had a whole lot of questions come in. I can't get to all of them, but you can reach out to us. You can go in the description down below. You can send us an email. You can schedule a time to sit down with one of our advisors. And the phone number, we actually do have someone standing by right now. If you want to get something scheduled to sit down and talk with one of us, we have clients from all over the country, and we do these through Zoom. So the phone number is 1-800-822-6434, 1-800-822-6434. Chris, any kind of parting words or final thoughts?
I would just encourage anyone out there who's watching, if you have questions about the markets or investments, send us an email and ask the question. We'll try to address it. We do 3 releases a week We do a weekend update. We do a news or noise on Wednesday. We do the podcast on Friday. All different lengths, all different kind of topics. We're always looking for new stuff. So, send us an email and ask a question.
Just to clarify, Chris is referring to send an email to help content for the podcast. We can't specifically answer your question without knowing the specifics about your situation. But if you have an idea, if you'd like to see a video, even me, the videos that I do on YouTube here, I'm always looking for content. I tell people all the time the most difficult part about the YouTube channel is actually developing content. So yes, if you have some ideas, feel free to send those in. James, any final thoughts?
Just to kind of go way back to kind of where we started the discussion about how right now we've seen 2 really good days in the stock market, so things starting to look like they could be heading in a different direction than they've been heading this year. Investors are always struggling with 2 emotions, fear and greed. The first half of the year it's been fear, and now that we've seen some upward momentum, greed should start to raise its head again. People will start worrying about missing the rally or missing the opportunity. FOMO, fear of missing out. And if you are an investor, if you're in the stock market or any sort of market, as much as possible, control these emotions. Avoid falling into the trap. You end up on this roller coaster where you buy at the very high and sell at the low, the exact wrong times of what you should be doing. Stay away from these emotional decisions. And if you need help with this, yes, by all means, reach out to us. We're always happy to talk to you and see how we can help you.
So we want to thank you very much for tuning in, and you guys have a good night, and we look forward to seeing you on the next YouTube live shoot. All right. Yay. Hey.